Welcome back. Well, after the latest interest rate increase from the Bank of Canada in July, Bank of Canada Governor Tiff Macklem said the central bank expected inflation to return to the bank's 2% target in 2025, months later than originally expected. But our next guest says disinflationary forces will be soon too strong to ignore. For more on what he describes as the bank's very hawkish bias, we're joined now by Benjamin Tal. He's Deputy Chief Economist at CIBC Capital Markets. Benjamin, thank you a great deal for joining us. You say that something that investors need to internalize is that the Bank of Canada giving much more weight to strong or hot economic indicators that would trigger a hawkish response from the bank. Tell us where you think the bank is going.
Yes, because quite frankly, this bank is not neutral. It's biased, and rightly so. We have to realize one thing. You give the Bank of Canada two options. One is a recession. The other is inflation, and inflation expectations rising. They will take a recession any day, because they know that if they overshoot, they can fix it by cutting interest rates. If they undershoot, then inflation expectations go up. You don't know what to do with it. So clearly they are biased, and they say, you know what, if we are going to make a mistake, let's overshoot as opposed to undershoot. Therefore, given this environment, theoretically speaking, for every good economic indicator, strong economic indicator, I can show you one indicator that is bad. But the Bank of Canada is putting more weight on the strong one, on the hawkish indicators, because of their bias. And this is something that we have to internalize. We have to make sure that we understand that the Bank of Canada is not a machine. Quite frankly, if the Bank of Canada was an AI machine, they would have stopped in June. This is not an AI machine. This is a bank that is run by humans. They have fears, they have doubts, and they don't want to undershoot. Therefore, whatever we see now, since the beginning of June, and maybe even to September, is pure overshooting by design.
A lot of people would say, Benjamin, that the Bank of Canada has done a pretty good job. Look at where inflation is now. The most recent reading came in at 2.8%, sub 3%, and quite possibly on its way to 2%. What is your assessment of the job that the bank has done thus far? Its mandate is to reduce inflation, which was running not so long ago at 8%.
Absolutely. I think they're doing a great job of fighting inflation, but they're doing maybe too good a job. Namely, they're overshooting, and the economy will suffer because of that. Listen, this is not an exact science. You don't know where to stop exactly. You know that you overshoot only in retrospect. I suggest that every economic recession over the past 40, 50 years was helped, if not caused, by monetary policy error in which central bank has raised interest rates way too much, exactly because of the fact that inflation is a lagging indicator. So I'm not criticizing the Bank of Canada. I'm just saying they know, I think, that they're overshooting. They would like to try to minimize the overshooting, but they're overshooting. And I think that if you look at the overall situation, they're basically buying time. Why do you think they're telling us now that inflation will reach 2% only in 2025? By doing so, you're actually not losing anything, because you keep telling the market, listen, inflation will go down. Therefore, you control inflation expectations. But at the same time, you're not required to respond to any hawkish economic news, because you know that you have time. So the Bank of Canada, by elevating the GDP growth and by increasing the duration in which inflation will reach 2%, they are basically buying enough time to minimize the error. That's more or less where we are.
Is the Bank of Canada swayed, do you think, by the pressures it knows it has imposed on many people with variable rate mortgages around the country?
Listen, I'm sure that what's happening in the housing market is impact their psyche, no question about it. Now, their mandate is not the housing market, it's the inflation rate. Inflation is starting to go down, but when you overshoot, we have to remember, we have been saying for many, many years that the Canadian housing market and households in general are very sensitive to higher interest rates, more sensitive than in the US because of the fact that we have more debt and our mortgages are for 5 years as opposed to 30 years in the US. Therefore, when the Bank of Canada is raising interest rates, you feel the pain. And people say, where's the pain? The consumer is still doing fine, because you can postpone the pain. But eventually, and this eventually will be, as we all know, 2025, 2026, where 55% of mortgage outstanding will be reset. That would be very painful if interest rates don't go down by then. They know that. I'm sure that that's impacting their psyche.
How far away are we, Benjamin, from the Bank of Canada actually reducing rates, or is it too early to tell?
No, I don't think it's too early to tell, but it's not going to happen anytime soon. Until very recently, the market was talking about the Bank of Canada cutting interest rates in the second half of this year. Back then, I was not sure what the market was smoking, and clearly that was not the case. The Bank of Canada is going out of its way to tell us this is not going to happen anytime soon. We want to make sure that inflation is absolutely dead before we cut interest rates. So when I say second quarter of 2024, maybe May, maybe June, that's a reasonable assumption at this point, and the Bank of Canada will start cutting alongside the Fed.